Hello and welcome to our continuing coverage here from Davos 2023. It's a very cold morning, so thank you very much to Bob Moritz and Sanjeev Krishnan of PwC for joining me here today. Gentlemen, I know it's cold. I'm going to keep this as brief as possible. For the benefit of our viewers, PwC put out its 26th annual Global CEO Survey yesterday. And very quickly, just to capture the headlines from the survey, 73% of the CEOs polled believe that they will see a global economic growth decline over the next 12 months. This is the most pessimistic outlook in over a decade that the PwC Global Survey has put out. Bob Moritz, I want to start with that. Through the course of the pandemic in 2020 and in 2021, the mood was completely different. CEOs were still optimistic about growth. What explains this significant departure where you have the most pessimistic outlook in over a decade?
Let's remember that the CEO survey is focused specifically on comparison to last year. So last year, coming out of COVID, we had an uptick. We had significant confidence that prior year was difficult. It'll be better this year. This year is going to be harder. The three things that are driving it being harder this year to see that growth: macroeconomic volatility and the disruption that we see, the combination of macroeconomic implications to interest rates and inflationary pressures, particularly the supply chains and the like, and last is geopolitical pressures now that are actually implicating the global economy in a big-time way. So those combination of factors are really causing that pessimism on the economy itself. The question is, how do CEOs manage through that?
You know, I'll get to the management part of it in just a second, but let's talk about inflation and interest rates. I mean, this is an era of high interest rates and high inflation that many CEOs who are in the hot seat today have not experienced. What is that going to mean in terms of how they navigate through this? What is it going to mean in terms of expansion, investment, private capex? What do you hear?
So what we'll probably see is first a real hard focus on cost and managing those costs as best they can, taking inefficiencies out of their organizations. They are going to try to protect as much as they can the human capital. Why is that? Because they see attrition staying the same. Even in a slowing economy, those with skills are going to be very valuable and very wanted by employees around the world. So you're still going to have to pay wages, benefits, and actually upskill the talent. The other thing that's going to happen is you're going to start to see some bankruptcies. Those organizations that were able to ride the curve, so to speak, and ride that wave, higher interest rates means they're not going to have access to free money, for lack of a better word. So we'll see bankruptcies. We'll see restructuring of debt quite a bit. And we'll see some organizations sell off businesses to create some value to pay that debt down. We'll see other organizations take some risk and actually say, hey, there's an opportunity to maybe out-execute my competition. So M&A will trickle through just in different ways around the edges of portfolios.
You know, it's interesting because you talk about insolvencies moving up. You're also talking about the possibility maybe of zombie companies and others falling by the wayside on account of the higher interest rate environment. But you're saying that companies at this point in time, and I'm caveating that, at this point in time, are not talking about laying off people, are not talking about wage correction either. So what we're seeing happen in the tech industry, you don't believe that that is going to be a secular trend?
So what you see right now is around the world, 60% of the CEOs are saying, I don't plan to do this as of today. But what you are seeing is across certain sectors, a little higher getting to yes to that answer. Chemicals and consumer, in particular globally, definitely are starting to potentially go in that direction. If you actually go a little bit deeper, in the US, you will have a higher proportionality of CEOs in the tech industry and the financial services industry that in fact are doing those headcounts because they are trying to get ahead of those issues, and especially when you look at the size and scale of those organizations in terms of what they're doing around the world.
I want to talk about, you know, different parts of the world, and let me start by talking to you about the US. Mixed opinion. Many CEOs that I've spoken to, some do expect the economy to move into a recession, albeit a shallow one. Others believe that we're probably going to miss out on one. What's the expectation specifically as far as the US economy is concerned?
So the US economy has got a degree of resiliency with it, and I think they're focusing primarily on how is the consumer situated, how are they doing in terms of their purchasing power and their debt ratios, and they still feel pretty good that they can work their way through that while we're watching the macroeconomic fiscal policies coming out of the Fed and the like. So the confidence level is generally good, with a warning sign that people are paying attention to, and a preparatory mindset, which is I got to get ready, be better prepared, and cut costs as much as possible, redesign my supply chain and my business processes. So you'll see structural transformation in the US, but the world's depending on it, and there is a solid foundation for it to actually say we feel good today. It's a worry about things tomorrow.
I want to talk about China because that is one of the X factors that everyone here in Davos is talking about as well. Reopened much faster than was expected. There seems to be some softening even as far as the regulatory crackdown on different sectors is concerned. What's the expectation? Because there is one view of anywhere but China, but that's not what you're saying.
No, we're actually seeing a little bit of opposite. You pointed already to some of the changes that have happened in China, the opening up, the combination of some of the policy changes that President Xi and the administration have changed to allow for that domestic agenda to come back to life again. And I think that's going to be very important, both in terms of the stability of China itself and getting to positive GDP growth, which it'll have, but also what role will China play in the world in terms of the investments they're making. Let's remind ourselves they were playing a big global role with their Belt and Road Initiative, and as a result, you want to see that come to life as well. So that's going to be a positive in the world today. It comes through in the CEO survey as well. That CEOs are seeing an opportunity in China, but they're going to do it differently. I'll come back to that. And second, the CEOs in China, much more positive compared to others around the world.
Yeah, I would imagine that they're banking on the fact that there is a rebound, and that it will impact the domestic economy. But specifically on global CEOs, and the expectation was that given everything that's happened, especially with the closing of the economy through COVID, as well as the geo-economic tensions, that global investors will now think twice about investing in China, or we may shy away altogether from investing in China. You're saying that's not the case?
No, we actually still see China as an investable opportunity, but we are seeing management teams that are already there or wanting to be there doing it in different ways. They're reorganizing themselves in China for the benefit of China domestic consumption, and then maybe separately what they do in China for then the rest of the world. So this way they have maximum flexibility and maximum optionality if in fact things go up or down in a significant way as they look ahead.
Okay, let's talk